So the fourth asset class is gold. And it's interesting to spend a little time on gold because there are some curious characteristics of this metal. First of all, it's not asset generating. It does not propagate or reflect the growth of a particular sector or industry. In fact, at one point in time, 80% of the gold was used for jewelry. And even today, as we speak, 50% of all gold consumption is for jewelry, which is cosmetic or ornamental. Use of gold in industry, in healthcare and all that is approximately about 10 to 15% and no more. Yet, it has a socio-historic significance. Gold for centuries and almost 1,000 years has been used as a storer of value. And for a long time, gold was universally accepted by everyone and anybody. Today, gold is considered as a safe haven, and often investment advisors and investors tell you that keep 5 to 10% of your wealth in gold. It can be in the form of physical gold as ingots, or it could be in the form of ETF, exchange traded fund, or it could be in the form of sovereign bonds, which the government or the central bank floats from time to time, where the underlying need not be actual gold they are holding, but that bond will move, its price will move in reflection to the movement of gold prices world over. So if it is a safe haven, often you wonder, would such a situation arise? And I want to give you two examples in the recent past where people like us would have thanked heaven and everybody for having gold. One would be in Sri Lanka. In the recent past, we saw the huge economic upheaval that happened in Sri Lanka. And if you are holding Sri Lanka currency or stocks of Sri Lanka company or debts, it would have amounted to nothing. But if your 10 to 15% of your wealth was in the form of gold, you would have slept much better knowing that regardless of the economic situation in the country, the gold would have been worth something. Indeed, you could get far more from that gold than you could from the local currency. Another example is Pakistan, where again there is huge economic turmoil. So it is not inconceivable that countries can run into difficulty from time to time. In India too, in early 90s, they had to give away gold from their coffers to get a loan from international funds. And therefore, gold plays a very vital role. However, one must remember that gold fluctuates substantially, and there is an inverse correlation to gold prices and appreciation with respect to shares and stocks. So when the prices of the shares go up, gold comes down, and the reverse happens. So if you look at, trace how gold has behaved, say between 2012 and 2022, vis-a-vis the stock market, the S&P 500 has grown by about 12%, while gold has grown by 3% approximately. If you take a longer period of time between 1978 to today, again, gold would have grown by about 5+%, between 5 and 6% in the period of time. But having said that, there have been occasions when gold has gone up substantially. In 2008, when there was the subprime crisis, debts and stocks all plummeted down, and in that single year of 12 months, gold appreciated by nearly 15%. Likewise, in the 80s, when there was an oil crisis, gold again went up substantially. The moral of all this is this, that gold should be part of your portfolio to the extent of 5 to 10%, not to get a huge return, but to be used as a safe haven.